All right, so today I bought Weight Watchers at $30, 200 shares, and sold the 28.5 call option for $3.60. So the way to calculate the profit on this, or potential profit, is I paid $30, but I collected 3.6. So my true cost is 26.4, and at a strike price of 28.5 by March 15. So come March 15, if Weight Watchers is trading above 28.5, then my shares will get called away from me automatically. So they will get sold at 28.5. They won't get sold at 29 or 29.5. They'll get sold at 28.5 because that's the strike price I chose. And 26.4 is my cost because I bought it at 30 and immediately reduced it by $3.60. But I can potentially sell it at 28.5 come March 15. So minus 28.5. So that's $2.10 profit per share divided by my cost of 26.4. So that's 7.9% in a matter of 3 weeks. And that's assuming that Weight Watchers goes down. The reason I chose a strike price smaller than my purchase price is because I think that the following direction of Weight Watchers is to continue to go down. If it goes up, then great. My profit remains 7.9%. The only problem I'll have is if it drops below 28.5 or even below 26.4. So I don't want it to drop below my cost, of course. If it trades at 26.4 come expiry date, then I break even. Nothing happened. If I sell my shares right away, or I could keep them and wait for it to come back up, but I don't want to wait. So I would prefer that it trades above 28.5 come expiry date so that they get sold automatically at 28.5 and I collect the $2.10 per share. If it's trading below 28.5, but let's say at 28.2 or even 28, I'm still going to be profitable because I bought it at 26.4. So I'll be making less of a profit, but if I want to sell it right away, I could sell it right away if I don't want to keep it. So $2.10 times 200 shares, that's $420 minus the fees of $42 if my shares get called away, so that I'm left with $378 on a cost of 26.4 or 2,640 times 2 because I bought 200 shares. So yeah, so after fees, it's about 7% in a matter of 3 weeks. So this is a deep in the, or not necessarily deep, but it's an in the money call option because the strike price is lower than your purchase price or the market price. So you're basically anticipating that the stock drops. So I bought it today at 30 and already it closed at 29. It's got earnings next week, so for sure that's going to affect it. Past month you could see it's stable but dropping. 6 months dropping, 1 year dropping. Ridiculous. If you look at 5 years, it's so weird. Back in 2015 it was trading at 29. Here, let's go even further back. June 2015 it was trading at $4. And then June 2018, so 3 years exactly, it's trading at $101. So it's ridiculous. But I mean, it's got a low PE ratio. 1 year target price is 72. Okay market cap. It's got a 2.1 buy rating. It's kind of risky, but call premiums looked really too good to ignore. Probably should have taken a strike price even lower. Would have reduced my profits, but it would have given me more downside protection. Now, a stock I really wanted to buy today, in fact I placed an order but it got rejected because I didn't have enough buying power apparently, is Square. Wanted to buy today at 74 and then sell the March 15 call option at a strike price that's in the money, so let's say 72.50. So I'd buy it at 74 and then sell the 72.50 strike price. I'd collect $5.10, pay 74.3, but I would immediately collect $5.10. So my cost of buying Square is 69.2, and then come expiry date, if Square is trading above 72.5, my shares will get sold at 72.5, but I bought it at 69.2. So that would be my profit. So my profit would be 72.5 minus 69.2, which is $3.30 per share. So that's $330 minus the fees, $288 in 3 weeks, which represents about, I said my cost was 69.2, so would represent a return of 4% in 3 weeks. And this one I would do it very comfortably because I think Square is going to go up, but just to be on the safe side, because I think it's gone up already a lot, it deserves to continue to go up, but technically speaking it might just take a little drop before it continues to go up. So just to be, and I think earnings are coming out in end of February, and usually when earnings come out it affects the stock and the call premium, of course. In fact, one of the reasons why these premiums are so high is because there's earnings coming up. So although it says here my buying power in US is 11,000, when I placed my order, it told me I didn't have sufficient buying power. So I don't understand why it did that. Have to call QUESTRADE and ask them. But I think it has to do with the fact that my margin account is linked to my TFSA. So based on the activity or on the balance of my TFSA, it actually affects my true buying power in the margin account. I was also looking at overstock.com. I placed an order at 19.5. It didn't go through. So this one has earnings around March 13. So I'd probably choose something before earnings. So expiring March 8th. So it's 2 weeks. If I was able to buy it at 19.9 and I were to sell these $18 call option or strike price, I'd collect $2.80. So I pay 19.9, but I immediately collect 2.8. So I'm down to 17.1. So that's my true cost. And then come expiry date, March 8th, if the stock is trading above 18, it's going to get sold at 18, but it cost me 17.1. So that 0.9 difference is my profit. So 0.9 divided by 17.1 is a profit of 5% in 2 weeks. If you want to annualize that, that's 136% per year. So what's great about writing covered calls is you could sort of make money regardless of the direction of the stock. You have to sort of predict the direction. So if you think a stock is going down, then you should sell the in the money. You should pick the in the money strike price. If you think the stock is going up, you should pick the out of the money strike price. If you think it's gonna trade horizontally, then you pick the at the money strike price. So another trade I made, I bought Crescent Point Energy because I was looking for a Canadian stock to buy. So I bought it at 3.92, 1,200 shares, and then I sold the $4 strike price, expiring on March 15. I sold it for 21 cents. Usually I don't like it when it has small amounts like that, because if the stock drops by expiry date, then next month my call premium is probably going to be worth 4 or 5 cents, so it won't be much. So anyway, so for this trade here, I bought it at 3.92, but I collected 21 cents right away. So it's like I bought it at 3.71. Come expiry date, if the stock is trading above $4, it's going to get sold at $4. So my profit will be $4 minus 3.71. So my profit is 29 cents per share. I've got 1,200 shares. That's $348 minus my cost of, we said 371 times 12. So 371 divided by 12. So that would give me a return of 7.8% before fees come March 15 if the stock is trading above $4. So of course, not bad. All it takes is for the stock to be trading above $4 come March 15. If it's not, depending on how far it is from $4, if it's my cost was 3.71. So I break even at 3.71. So I want it to be trading, of course, above that, but preferably above $4. So I get the full profit that I expected. So I'm really excited with this covered call strategy. I think my next video, I'm going to talk about the difference between dividend investing and writing covered calls, why I chose for this year writing covered calls as opposed to dividend investing, and give you some examples or some proof to why this might be better. And I'm going to sign up to this website tomorrow, but I'm going to take the 2-week trial first, try it out for 2 weeks. If I like it, then I'm going to have to pay for it. I have a feeling it's going to be worth it. It's going to be a major time saver, because right now what I'm doing to look for opportunities is, of course, looking at stocks that I'm willing to buy, but I'm going through them one by one, looking at their call premiums to see if it's worth it or not. But this filters automatically on the call premium for you, so you can quickly see which ones are interesting based on the potential return, and then you could filter based on the market cap, or if you want it to be in part of the S&P 500, or if you don't want earnings release to come before expiry date, if you want to capture a dividend. So I think it's going to be helpful, but I'm going to try it out for 2 weeks for free. I mean, I got a few stock picks from this website already, just from the 2 stocks that they're providing here as an example. I mean, PTI is a stock that I bought, and ASND is a stock that I bought. I bought it at 72, so it's already trading at 68, but I sold the 50 strike price. So as long as it stays above 50 by March 15, I don't care. So I gave myself enough protection by picking a very deep in the money strike price. And with PTI, I did the same thing here. I bought it at 4 and I sold the $3 strike price, so giving me enough protection. Right now it's trading at 4. So yeah, I mean, just this week in call premiums, I think I collected about 800. But in order to actually confirm these profits, the stock needs to trade above the strike price I want or not too far from it. So it's not confirmed yet. It'll be confirmed by expiry date. But I mean, for $60 a month, it might be worth it to use this screener. I also got 2 options expiring tomorrow. Intel expiring February 22nd tomorrow, and Micron as well. Where's Micron? Yeah, so Micron is here. So yeah, so I sold the call option for 99 cents at a 36 strike price, but I bought the stock at 33, I believe, and right now the stock is trading at 42. So of course the call option is worth $5. So of course I missed out on more profit, but I'm still profitable, about 9 or 10% in 1 month. So that I'm just gonna let it get called away. And Intel I bought at 46, but I sold the 48 strike price. So I'd collect an extra $2 here and the 75 cents that I already collected initially. So in the case of Intel and Micron, because they went up, it capped my upside because I didn't go far enough in the strike price that I chose. I chose $2 out, and here as well $2 out, and I did that because I wanted to collect a decent premium. Obviously I didn't know that they would move up so fast. I felt like they wouldn't surpass these 2 strike prices, but that won't be the case all the time, of course. Like in Activision, for example, I bought it at an average price of 44.7, and right now it's trading at 41.9. So come expiry date, which is March 1st, I'm going to be way below, the market price will be way below my strike price and my average purchase price. I'm sort of going to be stuck with Activision because I won't be able to sell call premiums next month unless I buy more shares and dollar cost average my purchase price. For example, if I wanted to sell 1 month out from today, which would be March 22nd. Right now it's trading at 42. I can't choose a 42 strike price because my cost is 44.7, and I could risk losing my shares at the strike price that I choose. So I need to choose a strike price that I accept selling the stock at. So since my purchase price is 44.7, I guess I can use a 45 strike price or even a 44.5 strike price, and I'd be collecting either 68 cents or 54 cents 1 month out. While when I first started this trade, I collected $1.90, so a big drop in the premium because the stock dropped. So basically that means I picked the wrong strike price initially when I started. I picked the 46 strike price when I probably should have picked an in the money strike price like 44 or 43. So the strike price is very important because based on the direction you think the stock will go in the time period chosen, that'll determine which strike price you choose. All right, so if you have any questions, leave them in the comments section below. Like always, if you're going to open an account with QUESTRADE to trade on the stock market, use my referral code in the description below the video to get between $25 and $250 back, depending on your deposit. Also, it's tax season. If you're looking for an accountant, don't hesitate to email me. Link will be in the description below the video. Thanks for watching.